we are going to start the session. I'm going to introduce our speaker for this evening. So I believe many of you already know who he is. So is currently the lead hedging consultant and also the risk management itself. Now, he's also a chartered market technician, CMT chartered holder. He's also he has extensive experience in coaching individuals with performance improvement, behavioral change, self-empowerment, and also personal breakthroughs. You can see that it's a very lengthy speaker profile for CY itself. So I'm going to pass it over to you, CY.
Good evening. I hope you're all doing well. So today we are going to navigate the opportunities in the palm oil market. So in Bursa Malaysia derivatives, we have our unique agriculture commodity futures, which is a popular traded, which is the FCPO futures contract. So whether you are a financial traders who aims to profit from trading price differences, or whether if you are a producer or commercial physical player who trades physical palm oil, now it's essential to consider a broader macroeconomic perspective to make informed trading decisions and manage risk. So as you may have already know that palm oil is actually one of many edible oils that play a significant role in the global edible oil market. So understanding a broader context of the oilseed market is important for you as a trader to effectively navigate the palm oil market, whether you would want to take a long position or take a short position. Because as a traders, it's important for us to understand the interaction of the market dynamics, the changes in fundamental factors behind that affects the overall supply and demand balances in the market. And therefore, these are the things that leads to price fluctuations and changes in trends. So when you are able to analyze these factors, traders like you can anticipate price movements and identify trading opportunities. Besides that, being aware of these changes in demand and supply also helps you to better manage risk effectively through strategies like diversification and hedging. Now, before I begin, I would like to know what would be your perception about the market. If you believe the market is bullish, you can type in bull in the chat box, or if you believe the CPO market is bearish, you can type in bear or down in the chat box, so that later on I'm going to share with you some of my analysis, and we are going to have a look and see what are the evidence that supports bull and what are the evidence that support bearish for the crude palm oil market. All right, so today we will be focusing mainly on the crude palm oil market itself. So whether it is bull or bear, do share your opinion in the chat box, because it allows me to know what would be tentatively what would be your intended actions in the market. All right, so there is no right or wrong answer, because all of us, we have different trading objectives. Some of us see information and we interpret it as a bullish, whereas some of us interpret the same information as a bearish. So I see in the chat box here there are a mixture of bullish as well as bearish. All right, so let's get started. And before we begin, I want to give a quick disclaimer. Of course, this presentation is for educational purposes only, and it's not intended as an investment advice for you to buy or sell futures contract, because in today's webinar I will be sharing with you my analysis so that you can see a bigger picture of the oilseeds market, not just only on the palm oil market. You will also roughly have an insight and perspective or about what is happening in the overall general vegetable oil market. You can also model my research method. What are the fundamental key as well as the key technical factors that I look at as a financial trader and hedging consultant. So fundamental factors, of course, it changes from time to time. We need to continuously monitor these changes to revise our expectation about the market. So besides that, by keeping an eye to those macroeconomic factors, you can better anticipate the market movements and make more strategic decisions in trading the crude palm oil futures. So that being said, I hope today's session will help you widen your horizons and expand your knowledge about the oilseeds market. So as Ting Ting has already mentioned earlier, my name is Chun Yen, but you can call me CY. So as financial traders, I am mainly a trend follower. So I profit from following the market trends like you, and I will also as trend follower, I will find information and evidence to confirm the market trend. And meanwhile, as a hedging consultant and a risk management consultant, I help corporate clients, whether they are producer or consumer of palm oil, to manage their commodity price risk, especially for adverse price movement, to improve their profit margin. So the research process in terms of interpreting the fundamental factors would be different as well. So hopefully in today's sharing session, you get an idea on how I would actually look at the market and what are the data and key information I would actually take into consideration for my analysis. So today's webinar is considered as an advanced level. I would say that it's a knowledge application based topic. So I assume most of you have a fair knowledge in fundamental analysis and technical analysis. So I will not be going to explain those basic definitions or concepts. And today I will be diving into 4 key topics that will help you understand the opportunities in the palm oil market. So firstly, in topic 1, understanding the oilseed market. Here I'm going to share with you a quick introductory about the oilseed market. And topic 2, I will directly go into the fundamental analysis perspective. You are going to look at what are the fundamental factors that I look at, and I'm going to highlight to you some of the significant key points you need to take note of. Topic 3, technical analysis perspective. Here I'm going to provide you several news perspectives that a majority of traders don't look at. And lastly, the opportunities and key trends to watch. Here I'm going to summarize and integrate all of the analysis so that you know what are the key opportunities and key trends available to you. So are you ready to see what unveils in the crude palm oil market in the future or not? Right, so let's get started. Now in this topic, I am going to share with you a quick introductory about oilseed market. You will understand what is oilseed market in general and what are the related oilseeds in relation to palm oil, and what are the countries you need to monitor when you trade the crude palm oil futures, because there are so much information out there, there are so much news. So of course, in order not to get overload, we want to just only focus on information as well as data that are relevant to the products that we trade. Now, here are the major vegetable oils used in the world. Sometimes the term, oilseed and vegetable oils are used interchangeably. However, there are some differences. Oilseeds generally are referring to seeds, nuts, or the fruits or the plants, while vegetable oils are the oils extracted from the oilseeds. Okay, so oilseeds, the vegetable oils, I would say, is actually the end product of the oilseed. Okay, but vegetable oils can be still further being processed as cooking oil, as well as used for pharmaceuticals, cosmetic or personal care products, and even industrial applications. So here you can see that here are the top vegetable oils used in the world. There are palm oil, soybean oil, rapeseed oil. Rapeseed oil, in other words, we also sometimes call it as canola oil, and sunflower seed oil. So here there are so many oils here. We just need to monitor the top 4 major vegetable oils, because these are the 4 oils that very significantly affect the global edible oil demand and supply, as well as the price itself. Now, when we break it into a country view, here we want to clearly go in a little bit deeper to see which country has the most production of vegetable oils. So here it's a list of countries that produce vegetable oils. Of course, it's a total of oils. So if a country that produces 2 or 3 oils, here the figure here is actually shown as a total production of vegetable oils. So some countries export vegetable oils because they have surplus in production, while some countries they import vegetable oils because they consume more than they produce. So they need to import additional vegetable oils to meet their own in-country consumption. Now here, let's have a look at the world distribution of the major vegetable oils. So which country demands vegetable oils where they export the most, and which countries they have excess supply of vegetable oils and they export the most. So let's have a look at importers first. We can see India, China, European Union and United States imports the most because they consume more vegetable oils than they produce in total. So although personally, in their own country, they do produce oil as well, but if we were to take the net total, they consume more vegetable oils than they produce. So which is why they need to import additional vegetable oils from countries that have a surplus. So here for importers, we want to focus on the top 4 countries will do. For exporters, we can see Indonesia, Malaysia, Russia, and Ukraine. They are the biggest exporters in the world. They export most vegetable oils in the world because they have surplus in production than consumption. Now, from this exporters table here, can you see which of these countries have geopolitical tension that is ongoing or not? If you do know which of these countries has a geopolitical tension ongoing, you can type in the chat box so that at least I know that you are relatively been in the market for quite some time already. Can you let me know which countries here has a geopolitical tension or having still have ongoing war? All right, so I believe majority of you who trade the crude palm oil understand this. If for those of you, if you are still relatively quite new in the market, probably you might not know what is happening on in the past. So here, yes, majority of you are correct. Russia and Ukraine, they have geopolitical conflict, especially they have war. So no wonder in early 2022, when there is a war initiated between these two countries, Ukraine and Russia, vegetable oils, the price spiked up to new historical high because there was potential risk in the supply reduction in the global market. So which is why buyers would want to actually willing to pay higher prices for vegetable oils so that they don't get disruption in their supply chain. So yes, even till to date, since early 2022, there is still ongoing conflict. So we still need to keep an eye on this geopolitical tension. Now, how about Middle East conflict between Israel and Iran? I believe some of you might be saying that you would generalize that as long as there is war, it would affect commodity markets or agriculture commodity markets directly. But in fact, you can see based on this exporter list or the supplier list, Middle East conflict, it has very little impact. In fact, it has an insignificant impact to the vegetable oil supply in the world because they are not the major vegetable suppliers. So in this slide, all you need to focus on is the top 4 importers as well as the top 4 or 5 exporters. Now let's have a look at the world distribution for palm oil itself. Now the key palm oil importers we can see here in the table, which is India, China, European Union, and Pakistan. They import the most because they consume more vegetable oils than they produce in total. And generally, based on the figure here, we can just focus on India and China, these 2 key importers for palm oil. Whereas for the key palm oil exporters, well, I believe it's self-explanatory. Both Indonesia and Malaysia are the major producers and exporters in the world for palm oil. So you just need to monitor the production in Indonesia as well as Malaysia. These 2 countries is good enough. So now that you have already gotten a basic understanding of which essential countries and vegetable oils to look at, now let's dive into the fundamental analysis aspect. When it comes to fundamental analysis, there are a lot of fundamental variables to look at. So it all, of course, boils down to 2 things, supply and demand. And here I'm going to share about the 6 key fundamentals I look at to analyze the trend of crude palm oil and other vegetable oils in general. So I will be going through production, stock levels of the agriculture commodities, the related edible oils, the trade distribution, the futures pricing, as well as the weather. Now let's have a look at Malaysia crude palm oil production, monthly production first. So here you can look at one of the, on the far right hand side, based on the recent publication production data published by MPOB on 10th of May, the crude palm oil monthly production is around 1.5 million metric tons. So it's actually quite near to the 5 years average. And here in this graph, you might see that there are peaks and bottoms on specific month. I'm not sure whether you notice or not. There are specific months that has peak as well as a bottom. So we are going to have a look whether there is seasonality in the production in the next slide. So here, same thing, it's the same data, it's just that in a different presentation method. Here we are going to look at whether if there is seasonal patterns in the production. So probably you might notice there is a pattern here. You can see that, in the first half of the year, the monthly production is actually less and is slowly increasing until around September and October, and then it falls on November and December. So simply speaking, from fourth quarter onwards, there is a decrease in production until end of first quarter of the year. So which means from November, December, January, February, and March, the production would be actually reducing. This is mainly due to the northeast monsoon, whereby October until March mainly is actually a rainy season. So harvesting would generally slow down, and it's actually a perfect time for the oil palm trees to cultivate for them to grow their fruits. And similarly, in second quarter and third quarter of the year, the production pick up and increase due to increasing in harvesting volume. So looking at this CPO monthly production data for year 2024, January until April, there is no abnormalities here. It is actually quite in the normal range. How about stock level for Malaysia? Now, stock level is actually one of the important factors that we need to look at. Stock level here refers to the inventory level, the palm oil or the inventory of the vegetable oils that is not used. So here we want to look at the ending stock level, whether there is an increased demand or consumption. So generally speaking, when there is increasing in demand or consumption, stock level would reduce. So here you can see there's also seasonality patterns in Malaysia CPO stock level as well. So it is quite in line with the increase in production in quarter 2 and quarter 3. You can see that in the early of the years production is less, so hence the stock level is actually reducing, and then when it comes to the second half, your production increase, your stock level would of course would grow as well. Now, how about stock level in China? Now, looking at this graph, China's stock level seems to approach on the lower side. It actually falls near to the 1 standard deviation, whether it is positive or negative perspective. Now, it depends on how you look at it. So, if you were to look at, not just looking at the commodity news in the China market, we also want to look at the China economy as a whole, as well as the China stock market. So looking at China market, the banking sectors seem to have a recovery already. So if you may have noticed that banking sectors, most of the banking stocks, majority of the listed banks are actually breaking 1-year high. So this is actually quite in line with this oil and fats ending stock level here, where it actually indirectly indicates that the consumption might have a recovery and there is an improvement in economic activity. So which is why the stock level is actually dropping. Besides that, it may also indicate demand might be rising in the future. Now, looking at monthly basis to compare year to year for stock level for China, we want to investigate to see whether there is also seasonality in the stock level as well. So there's a pattern here based on the graph. We can see that on the first half of the year, China's stock level would actually reduce, and it will bottom out around June or July, and then it increase stock level in second half of the year. Besides that, we also want to look at the stock level for India. Looking at this graph, India's stock level is quite similar to China's stock level. It's actually having quite a sharp drop. It's actually reducing. So this may signify improvement in economic activity and increase in consumption as well. So of course, if you have been following India's economic news, there are several major happenings for India. Starting year 2020, end of year 2022, you may see that there are many multinational corporations. They stated that they have intention to move their manufacturing plant or their manufacturing production to be based in India. Okay, they want to move their manufacturing plant from China to India. So for example, you can see Apple has already done that. So besides that, another significant happenings in India is that this year is actually India's presidential election. So it has already been started, and it will be end pretty quite soon in early June. So later on, we are going to see whether if India's presidential election has any impact on the crude palm oil or the vegetable oil consumption. Now, looking at the yearly comparison to see whether if there is a seasonality for India stock level or not. So here is quite same as China stock level as well. The stock level generally bottom up around June or July, and then increasing stock level after that. So for year 2024, of course, we can see at the green line here, it's somewhere in between this range. So there is no significant abnormalities here. Now, looking at soybean oil, because soybean oil is actually one of the vegetable oils that is widely used in the world. So we would also want to look at, besides how does soybean oil affect palm oil pricing. So throughout 2023, you can see the spread of soybean oil towards palm oil is actually very wide. So in early 2023, on the red color line compared to the green line and the purple line, which is the palm oil, the spread is actually very wide. So soybean generally is trading at a higher premium to palm oil. However, approaching to year 2024, you can see that the spread is actually narrowing. So this indicates that soybean has becoming relatively cheaper rather as compared to palm oil. So in other words, buyers may prefer buying soybean oil over palm oil because it's relatively cheaper. So palm oil currently, comparing with soybean, palm oil is actually facing pricing competition against soybean oil. So in order to be able to compete with soybean oil, logically speaking, palm oil got to price at a better discount to be able to sell better. Besides that, looking at soybean, the U.S. Department of Agriculture in their March report, it indicates that U.S. farmers they intend to increase the soybean planted acres in year 2024 as compared to the previous years. So it is estimated to increase by around 3 million acres, which is higher than previous year. So this means that there will be increasing of soybean production and supply in the market to compete with other vegetable oils. So here, generally speaking, soybean planted acres would be increasing. So it also indirectly means that soybean oil might potentially increase as well. Now, just now we look at soybean oil versus palm oil comparison. Now we look at the soybean the oilseed comparison with other vegetable oils. So here we can see palm oil is not just only competing with soybean oil, but also sunflower seed oil, as you can see in the yellow line. So historically speaking, you can see, from far left to the far right, historically speaking, the sunflower seed oil, which is the yellow line, it's pricing above, it's trading at a premium compared to soybean oil and palm oil. And now, uh, starting year 2024, now sunflower seed oil is actually trading relatively cheaper than soybean oil and palm oil. So this is because Ukraine has actually increased their area planted for sunflower oil seed and soybean in 2022 and 2023. So there is a surplus in sunflower seed oil. And besides that, because due to Russia and Ukraine conflict, in order, as a seller, you do know that, if you want to get rid of your stocks quickly, you need to price it cheaper compared to other competitors. So which is why, for sunflower seed oil, they are actually aggressively selling in the market, which is why they are selling at a way discount compared to soybean oil and palm oil. Now, another supporting evidence to look at, which is, the lower Ukraine sunflower seed oil export price. So which is quite in line with just now, which I shared with you earlier. Internationally, global sunflower seed oil actually increased to a record high, because in global, the sunflower seed oil traded is actually raised on higher imports from India, Egypt, as well as European Union, because Russia as well as Ukraine, they both of these countries, they are the biggest producer for sunflower seed oil. So as the European Union nations, right, it is very near towards Ukraine, right? So in total, for European Union countries, for them to import a cheaper oil, the total cost of getting sunflower seed oil is actually their cost would be way lower compared to getting soybean oil or even crude palm oil. So which is why you will be seeing that the export of crude palm oil towards European Union and India would be actually reducing because of the stiff competition from sunflower seed oil compared with other vegetable oils such as soybean and palm oil. Another perspective that you can look at is that you can see, sunflower seed oil has been trading at a discount compared to palm oil since January 2024, which resulting in a higher demand for countries like India and European Union. Because, as I've already mentioned, historically, sunflower seed oil has been a premium price oil compared with palm oil and soybean oil, because sunflower seed oil is considered as non-genetically modified vegetable oil. So relatively low sunflower seed oil prices in Ukraine are driven by higher domestic sunflower oil supply, because they want to compete with Russia in terms of selling their sunflower oil. So which is why it reports a larger supply here. So in addition to that, Ukraine, because of war, a weaker Ukrainian currency further supports Ukraine's export volume for sunflower seed oil. So which is why you can see, European Union and India, both of these nations, they benefit from a cheaper sunflower seed oil. So you can observe that India's sunflower seed oil import increased, while India reduced their import for palm oil. Why? Generally speaking, is because sunflower seed oil is actually priced cheaper than the alternative palm oil. Now, during Ukraine and Russia conflict, right, you can see that the production and export of soybean in Ukraine is actually reduced. However, after a few months, the conflict, after, a few months setting out of the war, right, you can see that the production and export is actually increasing for Ukraine. So the soybean production in Ukraine is actually export driven, and with the expanding in Russia in of Russia invasion, the exportable supplies for Ukraine has been actually on the rise. So production has already recovered as compared to pre-war levels because soybean it's always remained a profitable segment for this Ukraine. So which is why Ukraine focus a lot on soybean, and Ukraine's remain an attractive soybean supplier to European Union region as well as for Middle East, because their export price is significantly priced below anywhere else in the world. So because of a geography location advantage, countries around Ukraine they actually have a benefit for cheaper soybean as well as sunflower seed oil. Now that we have already looked at several fundamental factors, another fundamental factors that I actually look at, besides looking at production, besides looking at import, export, and stock level, another segment that I, look at is actually on the futures market itself. Now, there are several things in futures market that it actually signifies whether a commodity is actually in a normal market or it would actually be in a bull market. So generally speaking, for agriculture commodity market, it is always constantly traded at contango market. So in commodities trading, contango actually refers to a situation where your future price of a commodity is actually to be higher than your current spot price. So this is happens is when because there is abundance of stock right now. So in normal agriculture commodities experience contango situation because especially on seasonal aspect to their production, or if there is any expectation of increase in demand in the future due to population growth or changes in consumption patterns. So here you can see that for corn, this is actually a contango market. You can see the near futures contract is priced at lower price, and then the further futures contract further month is actually priced a little bit more expensive. So this same thing goes for soybean futures. The near month is actually pricing cheaper and further month pricing a little bit more expensive. Same thing goes for soybean oil, wheat, and canola. Then how about crude palm oil? So here you can see on the left hand side, these are the contango market. This is what we call as the normal market situation. Whereas for crude palm oil, looking at crude palm oil futures, now I believe all of you might be, although you are, for retail traders, you might be just only trading the third active contract month, right? Because of high trading volume. But we are interested to look at some other months as well, especially for spot month as well as second month. Looking at the crude palm oil futures, we can see that it's actually quite a backwardation market where the spot month is actually trading higher than further months. Now this means that the demand for near month is actually higher than further months, and this usually happens when there is anticipation of low supply in the next further months, or buyer is actually, simply speaking, if there is actually no low supply in further months, buyer, another reason to explain this is that buyer is willing to actually pay higher price right now to get the stocks. Okay, so commodity buyers are willing to pay higher price now as compared to further months. So we can see, backwardation happens for a consistent period of time during the early stage of COVID. Okay, it has been happening for some time. Otherwise, during normal market conditions, when there is no COVID, when there is no war, generally speaking, for our futures market, especially for agriculture commodity futures, it is actually pricing priced like a contango method. So in short, to make it simple, all you need to understand is that for agriculture market pricing structure is contango for normal market situations. So when the crude palm oil turns back to contango situation, then that is what we call it would be a normal market situation already. However, let's have a look at the next chart here, whether CPO is going to turn contango or not. So generally speaking, you can see that starting year 20, right before COVID and during COVID, right, it has been quite some time that, CPO is trading at backwardation, whereby your spot month is trading higher than your further month. So here are the 3 months future contract, May, June, and July comparison. And we want to observe starting 16 of the month onwards, so that on the data it's more reflective towards the current situation. So as we look at the futures contract pricing structure for CPO, is actually still backwardation. Here we can see that the pricing differences between each contract is actually from the left hand side to far right hand side, it is actually getting narrower. In other words, the spread is actually narrowing. So as you know that in normal market times, the pricing structure for agriculture product is contango. So looking at these charts, once the spot month and second month is actually trading lower than the third month. So this indicates that the demand and supply situation would be actually back to normal conditions already. Now, how about weather impact on El Nino? Whether El Nino does impact your CPO production or not. So can you let me know whether does El Nino affect your CPO pricing? If you believe El Nino affect your CPO pricing, you can type in yes in the chat box. If you believe El Nino does not affect CPO pricing, you can type in no in the chat box. So I would like to see whether, as a financial trader, what would be your interpretation for, how does weather impact your CPO pricing? This is actually a very interesting study where probably, you might be surprised with the answer. So I see majority of you put yes in the chat box. Now, before I reveal the answer to you, let's have a look at El Nino. Now, how does scientists measure El Nino? Is that they use this indicator, which is the sea surface temperature, SST. Sea surface temperature. They want to look at abnormalities. So of course you can see on the red zone on the upper side, which means higher temperature, higher than normal. So this is what we would categorize as El Nino situation. And on the lower side, where the temperature falls below normal situation, this is what we call as La Nina. So in El Nino condition, it means it is hotter than usual and you may expect less rainfall. Whereas for La Nina, it's cooler than usual and you may be expecting more rainfall. So for the first half of the year 2024, you can see that it has been 4 months that we are still in El Nino condition. However, the rainfall in Malaysia, I believe if you're still residing in Malaysia, the rainfall in Malaysia is actually still quite okay. So in fact, whether El Nino impact CPO pricing or not, you can actually go to Google Scholar to find El Nino effect on CPO pricing. Researchers and scientists has already found that there is no significant relationship for El Nino affecting CPO pricing. However, El Nino does affect CPO production, but it is not an immediate effect. Okay, so El Nino, it affects your production later in a later 5 months or 6 months to come. Okay, because for example, when you if you got do any planting or botany at home, you can see although there is El Nino, right, your plant may not get affected as long as you provide sufficient water to your plant. Okay, so similarly, whether El Nino affect CPO production or not, it actually it is conditional upon whether there is sufficient rainfall in our country to support the production of palm oil. If there is less rainfall and it is somewhat under El Nino condition, then yes, it would affect CPO production, and later in 5 months, 6 months later, you will only see there is impact in the CPO production and CPO pricing. Okay, so generally speaking, for El Nino, it does not have significant relationship towards CPO pricing right now. Okay, it only has it is a little bit lagging. It has relationship where it affect the harvesting of the fruit in a later period. All right, so here I've already shared with you some of the few fundamental factors that I will look at when it comes to fundamental analysis, because there is not all information in fundamentals that you need to look at, but we want to look at the significant ones. Now let's enter into the technical analysis perspective. Now, of course, technical analysis, I believe majority of you are technical analysis practitioners, so I'm not going to go into the looking at drawing charts and so on and so forth. So I want to, here in technical analysis, I want to highlight to you some other perspective that majority of the traders don't look at. And especially if you do trade US futures, definitely you would look at this commitment of traders report, because in Malaysia, we do not have in Bursa derivative Malaysia, we do not have this report. And if you just only trade the CPO futures market, then you might not look at this. But if you do trade US futures market, then this report is definitely very important to look at. Now, what is the commodity commitment of traders report? In other words, we call it the COT report. So this report is actually a weekly publication issued by the CFTC, which is the Commodity Futures Trading Commission in the United States. So this report, it provides insight into the positioning of various market participants in the futures market. They particularly focus on the positions held by the three groups of key participants. Okay, they group it by commercial, non-commercial, and non-reportable. So commercial traders, they are typically entities that engage in hedging activities. So they, for example, they produce commodities, or they process or even merchandising commodity. So they use futures contract to hedge their commodities price risk. Whereas for non-commercial traders, these are the traders, they are the one that manage funds. They speculate commodities price, or they trade commodities with a main objective of profiting from price differences. So non-commercial traders like hedge funds manage funds and manage money, or commodity trading advisors. So they are the one, in other words, what we laymen call is that they are also one of the smart money. And the third group of market participants are what we call as the non-reportable traders. So these non-reportable traders are what we call as typically small traders, whereby the position does not meet the reporting threshold that is set by the CFTC. So like us, retail traders, we are considered as non-reportable trader. Now, why this COT report is important is because, every week this report will be published. So it will be published, we will be able to see what are the open interests as well as the changes in open interest for these three group of market participants. So by analyzing this COT report, it can actually gives us, it provides a valuable insight into the market sentiment and the potential price movements. What are the hedges are doing in the market? What are the non-commercials, those hedge funds are doing in the market? What positions that they are holding? By looking at these large changes, or the changes in position for these two main participants in the market. So this is where it gives us an additional perspective of what is the smart money is actually doing. Okay, so the commercials and non-commercials, they are the most updated. Because they are in the market, right? They know their industry very well. They also get the most updated information, whether does the commodity industry they are in. So commercials, they are very quick in their response in hedging their commodity, to manage their commodity price risk. Whereas for non-commercials, like hedge funds, they make money by trend following. So again, they follow the trend by adjusting their positions to follow the trend. So traders and analysts, generally, they often use this COT report to develop trading strategies and assessing market dynamics. So, which is why this report is actually very important. So, in technical analysis, we do actually use this as well. So let's have a look at soybean futures. So of course, I'm not going to explain further on the chart above, right? I believe you already can see, if you were to be able to draw a chart, you can see it's actually clearly a downtrend. But here, what I want to highlight to you is actually on the commitment of traders, the COT report here. So here there are two main lines we want to see, which is the blue line and the red line. So blue line, which is the commercials, you can see that, for an uptrend in the early days in COVID period, right? When there is uptrend, those commercials, they are actually having a net short position, okay? So above zero, in the middle line is zero. Above zero level means it is a net long. Below zero, it means a net short position. So here we can see during an uptrend, the commercials, they are actually having a net short position because, price goes up, right? Commodity price goes up, soybean price goes up. So it's a good time for them to actually lock in at a higher price to sell even more. So when price goes up further, they want to sell even more. Now, on the contrary, which is for those hedge funds, those non-commercials, remember, they are a trend follower. So as price goes up, they would actually increase their net long position. So price goes up, they long even more. Price goes up, they long even more. So these are the two main group of traders. I would like to call them as smart money. We want to follow them because they know the market very, very well. Now, looking on the right hand side, we can see that as price goes up, starting to coming down, right? You can see the non-commercials right now compared to the early days, they are actually reducing their net long position already. Okay, as price moves sideways a little bit, they're starting to reduce their net long position. So up to date, you can see on the far right hand side, the red line is actually below zero. Now this indicates those hedge funds, they are actually in a net short position. Okay, net short positions means that they are anticipating that these soybean futures is actually turning. They are bearish towards soybean futures. Whereas how come you can see why commercials they're actually turning from net short position to net long position? It's because remember, as commercials, when price gets cheaper, they will buy even more. Okay, so that as compared to early days, right? Early days the price is high, they buy less. You can see by reducing in terms of net open interest for commercials. When price comes down even more, they buy more, which indicates a higher net long open interest for commercials. Okay, so here probably you can see what are the smart monies of this commercial and non-commercial is actually doing in the market. And another supporting evidence that you can see that is that your RSI here currently is actually trading still trading at below 50. So below 50 for RSI, it means it still signifies a weakening market, a weak market. It is not a strong bullish market yet. So now that you have already looked at what the smart money is doing for soybean futures, let's look at what the smart money is doing for the soybean oil futures. So soybean oil futures, looking at the chart, you probably can identify what trend it is already. And here, again, we want to look at the commitment of traders, mainly the commercials and non-commercials. So looking at the far right-hand side, you can see that, as soybean oil price comes down, commercials are actually buying more. Whereas for the hedge funds, those non-commercials, because they are trend following, they expect prices is actually a bearish situation. That is why they are actually holding a net short positions in the market. Another supporting evidence to confirm this as a bearish market is that looking at the RSI is actually still trading at below 50 for quite a significant time here. So it indicates weakness. Now, how about for corn futures? Now, probably why you may be asking me, how come we just only looking at oilseed market, right? Corn is actually, corn oil is actually not a major vegetable oil here. But why do we still actually need to look at corn? Now, in fact, corn and soybean has a very close relationship because there is a crop rotation in terms of planting corn as well as soybean. So which is why I use corn futures to support my hypothesis in soybean. So here you can see the corn futures, it has a similar pattern whereby the non-commercials are having a net short position and the commercials are having a net long position as price comes down. Why looking at corn futures? Because, although corn, yes, it has low impact on the oilseed market. I look at corn market to support, as mentioned, to support my hypothesis and opinion about the trend in soybean market, because corn and soybean, it has high correlation because they have a significant impact between each other, especially on the food production and animal feed. Farmers generally they rotate soybean and corn crops in the field because this actually after they plant soybean for the same land they would actually interchangeably use plant corn. So which means they for the same piece of land there would be a competition in terms of planting soybean and corn. If you plant more soybean, it means you will be planting lesser corn, and if you plant more corn, which means you will be planting more soybean. So these two crops, they are generally compete for acreage. So farmers generally, for producers, right, farmers, they would consider a lot of factors when deciding which crop to actually plant, including, market price, the soil conditions, and the weather patterns. So here you can see, earlier I've already shared with you on the fundamental factors, US, whereby they are actually, the report shows that, the farmers are expected to plant more soybean. There would be potential increase in the soybean plant acreage, which means the crop there currently there will be actually a surplus of corn already. So now they will want to increase in soybean plant and then reduce in corn. So in the near future, probably you may be expecting is that as soybean acreage is increased, your soybean production would increase. So this would actually, support that the soybean oil would be likely increase as well, right? So here it's here we have already seen soybean oil futures. Now, how about back to our CPO futures here? Now, of course, as I've already mentioned, in Malaysia, CPO futures, we do not have a COT report to look at. However, we can actually look at our open interest data. Now, open interest means the similar like COT report. It's just that, open interest, it's a more general report. It's not the breakdown report that breaks into what specific market participants are holding their position. So open interest, it means the general market participants whereby they haven't close their futures contract yet. So how we can apply open interest in Malaysia CPO futures here is that we want to look at the unusual spike or unusual increase of open interest volume here. Okay, you can see, if you look at open interest for Malaysia, right, there are certain spike and then there are always deep down. Okay, because we are, for retail traders, even for hedges, we would be generally, trading the third active month contract and then rolling over forward, right? So which is why when there is dip here, right, this continuous chart, it means that, traders are actually rolling over to the next month contract. So generally speaking, all of this dip, the sudden fall in open interest is because, participants in the market, they are actually rolling over their contract. So we do not want to look at the significant decrease in open interest. We just only want to look at the sudden spike of open interest. Now, how do we apply this? Is that all you need to look at is the unusual hike in open interest after a trending period. Okay, this signifies that the trend is actually about to end, whether it is a peak and whether it is a bottom. Okay, so let me know whether you're still following me or not in the chat box. If you're still following me, you can type in yes in the chat box. I would give you another explanation again. How you can apply this open interest is that we want to look at after a trend, and then only we look at open interest. Okay, after a trend, only look at the spike in open interest. If there is no trend initially, the spike in open interest data, there is no it's not meaningful for you. So here you can see, we starting from the far left hand side here. First is that when there is a there is a uptrend here, and then there is open interest spike compared to the previous weeks or days. So it means that there is potential reversal in the trend. Okay, so similarly on the second part, you can see when there is a significant long duration of an uptrend, and open interest, there is a spike, trend is about to reverse. So moving forward, and you can see all of these are actually, at all these peak point, this is where there is a spike in open interest. So now we actually can look at the further right in our recent market this year. So of course, in the last month, CPO, surprisingly, it went back above 4,000 level. You can see that, yes, it goes up above 4,000. However, there is a certain spike in open interest. So you can see there is actually, looking at the unusual spike in open interest after trending period. So this signifies, it confirms that the previous uptrend is already come to an end. Okay, so hopefully you are able to see the relationship between open interest and crude palm oil, the trend that you can actually look at. Now, in applying technical analysis, sometimes the rule of thumb is actually drawing and identifying patterns. As a technical analysis, we are not interested in developing quantitative or econometric forecasting model to forecast price. So we just want to look at visible patterns to forecast price patterns. So looking at the past, right, you can see that in year 2003 onwards, because we have stock market crisis in year economic downturn in 97, and then there is a boom and bust of commodity markets, and then you can see commodity price stabilized at year 2003. So it takes years until it goes back up again when economics started to recover a bullish economic market. So here you can see the previous earlier price range is about 1,002 to 1,006, but here we just take the high range and the low range, so it's between 1,002 to 2,000. And similarly, because I draw the price starting from 2003, right? So the similar happens is that I starting to draw from year 2013, okay, the year that ends with the number 3. So year 2013, you can see a similar pattern. Price goes around within a specific range. So this time, price goes between 2000 to trading 2000 and 2008 until there is another certain spike here, which means usually commodity has their own super commodity cycle, or commodity cycles in others we call it as, is when when there is at the end of economic boom, there would be a commodity spike, and after a recession again, there will be a commodity bull market. So this is where why I use after a stabilized period, which the year ends with 3. So again, you may have already guessed it. Which year that I would be using as my benchmark would be year 2003. So here, year 2003, again, we can do a brief forecast using technical analysis. Within the range is actually, I would like to go, you can see earlier, 1,002 to 2,000, 2,000 to 2008. So the next thing, logically speaking, is that I will be starting 2008 with until 3006. However, because taking on the previous support, right? So here we can actually use 3002 to 4,000, another $800 as a benchmark. So here we can see crude palm oil has been trading between 3,002 to 4,000 for quite a long time already. So we can see price at 4,000 level is actually a very, very strong resistance. You can actually take the data starting from 1st July 2002, which is where it's starting to trade below 4,005. So from July 2022 until to date, so 73% of the time, the price is actually trading below 4,000 level. So here we can derive a conclusion is that, at 4,000 level, the crude palm oil price is actually very, it has a very strong resistance. And not to mention that, there are a lot of supporting evidence earlier whereby, crude palm oil is actually trading relatively expensive than soybean oil and sunflower oil. So for crude palm oil to compete in the market, it has to trade at a more discount price or a relatively cheaper price compared to other edible oil. All right. So looking at the opportunities and trends to watch. So just now I've already shared with you what are the fundamental and technical factors to look at. So here I'm going to summarize what are the conclusion and the points, the evidence that we gathered from my analysis. So far, these are the data or evidence I've gathered. So I've already shared with you that, competing sunflower oil are price that is trading very, very discount compared to soybean oil and crude palm oil. So unless sunflower oil goes back, trading at a premium, way premium compared to soybean oil and crude palm oil. Otherwise, as crude palm oil, right, we have a competition to be competing with all these oils. So pricing wise, in order to compete with other oils, crude palm oil has to trade way cheaper than sunflower and soybean oil. Second thing is that I've already showed to you is that, in US, there is increase in soybean plant acreage starting this year. And in fact, for Ukraine, right, Ukraine, they have also starting year 2020, at the end of the fourth quarter, year 2022 until to date, Ukraine has also increased their soybean oil, soybean plant acreage. So this, might conclude is that in future, you might see a potential increase in soybean production this year when there is a harvesting starting September and October onwards. Because now May and June period is actually the planting season for soybean. So you might be seeing potential increase in soybean production. So some other factors that you need to look at is actually India trade policy after presidential election. Now, it doesn't really matter which president or which party get elected, because those are not so directly, not a direct factor towards looking at the agriculture market pricing. But what we want to look at is actually the trade policy that is actually have a significant direct impact towards the crude palm oil as well as the vegetable oils in general. The other thing, of course, it would be Indonesia domestic policy for palm oil. As you know that, in Indonesia, they have a strict policy, domestic policy, whereby they do restrict and they want to save up a certain supply for their own domestic use. So until and unless Indonesia relax the domestic policy to increase the supply, the export of crude palm oil in the market. So these are the things that you just keep in view to see that what are the changes in that. So far, here I will put it as a neutral first, but it's important to keep in mind. Next thing would be the export demand to China and India. So just now we have already seen that China and India, their stock level are relatively low. So you might be seeing that starting June, July onwards, they might be restock and increase their stock level back to normal levels. And another economic indicator that we want to look at for China and India is that do look at economic indicator for improvement in economic activities. So if there is improvement in economic activities in China and India, then yes, the domestic demand for these two countries, they would actually demand more vegetable oils in the market. And of course, only one supporting evidence that the support, if there would be bullishness for vegetable oils, would be the geopolitical tension. in Russia and Ukraine. The conflict is still ongoing. It haven't ended yet. However, it seems like the the vegetable oils or even the crude palm oil has been stabilized for quite some time. And looking at the commitment of traders report, evidence is that the smart money, especially the non-commercials, they're actually at the net short position side already. They are quite biased towards the downtrend. So all in all, you can see that majority of the evidence here through my data collection is that it actually tilt towards downtrend. So this is actually just only your reference as a guidance to for you to position yourself, to revise or even revise your trading strategy, which direction that you want to trade in the market. So my view is that palm oil prices, because of this evidence that I've gathered from the market, I see that there is a lot of downward pressure towards the second half, especially if you look at there is increase in soybean plant acreage and soybean production, then this would actually add more further downward pressure towards palm oil. So for second half, I expect the crude palm oil to, at least for futures crude palm oil, to be trading somewhere around 3,002 to 3,005. Now, whether is it possible for CPO to trade lower than 3,002? Yes, it's possible. Of course, it's conditional to soybean oil and sunflower oil. If those vegetable oils, they are pricing relatively cheaper than palm oil for a sustainable period of time, and if they are still looking quite cheap compared to palm oil. So very simply, speaking, is that palm oil need to compete with these premium oils to price at a lower price. So hence the palm oil price has to come down a lot further to compete with those other oils. All right, so that's it. That's my view and opinion towards the vegetable oils as well as palm oil. So hopefully you have a rough idea about what is the opportunities for you to trade, as well as if you're commercial, if you're a producer or consumer of palm oil, then it's important for you to take this into consideration in terms of hedging your commodity price risk, because when there is adverse price movement, it would definitely significantly affecting the profit margin. So it's important to look at the threats and opportunity to position yourself to hedge in the market. So that's it for today. I hand this over for Ting Ting.